I really see us as the traders under the tree, that we're here at the birth potentially of a nucleus of the next wave of cloud, which may stand for the next several hundred years or for all eternity, subject obviously to asteroids crashing into the planet and those kinds of things. I wrote a little blog post called Hedging Your Options for the Cloud, where I talked about the inevitability of dynamic pricing and derivatives and markets and exchanges. The comments to that were really funny because I drew a parallel between the perishable capacity of cloud computing resources with the perishable capacity that airlines had, and pointed out that, of course, if you're an airline and you've got a plane that's about to take off and there's one seat left on that plane, selling it for a nickel or a nickel more than the marginal cost of the fuel required to fly that additional passenger is economically viable as long as it doesn't destroy the structure of the pricing for all of the other participants in the market. So the comments were funny because they basically semi-kindly said, Joe, you're a moron, and here's why airlines are completely different than cloud computing. The next day, Amazon announced spot pricing, and at that point the debate ended on that particular topic. The comments came to an end on that. And so, I think this is really interesting because we have some of the smartest people in any room that kind of all got cream-skinned and selected to be here. We've got a lot of luminaries. We've got Ruth Cohen, who created the first spot market at Anomaly. We've got James Mitchell, somewhere there he is, who created the first broker-dealer for cloud. We've got the first cloud insurance people through Mary Beth. So kind of we can go along here, and I really think the traders under the tree is probably a good analogy.
I'm not an IT guy. I'm a trader by background. So I used to work at Morgan Stanley. I used to get involved in coal trades, electricity trades, carbon emissions trades, aluminium trades, all sorts of different things that are called commodities. Now, what I find very interesting coming into the IT market and little throwaway statements like things need to be standardized to be a commodity. I have no idea what that means. None of the stuff that I used to trade was standard. I put in a £2 billion bid in order to buy Europe's largest coal-fired power station. There's only one of those. It's not standard. You turn it on and off, and the way that it turns on and off is very different. One of the areas that I did want to talk about is the rationale for why people need certainty in the future price of cloud. People put up Moore's law as it's going to get cheaper over time. That's just known as a backwardated market. Perfectly normal. The question is, what is the shape of that decrease in price? Will there ever be any humps in it? And will the shape of that vary over time? Why do you care about that? Okay, let's look at a coal mine. The analogy here is that you are a producer of cloud. The coal mine needs to invest capex in mining equipment, and he wants to borrow money to avoid bringing all of the equity to the table himself. The bank says, what are your future revenues going to be? And he says, I don't know, it depends upon the price at which I sell my coal. Now, two lumps of coal are not the same. If you compare South African coal with the lignite that comes out of Germany, with the high sulfur coal that comes from Indonesia, there's lots of different characteristics of the coal which crucially can be measured, but it's all different. If you then look at the power station, the consumer of this commodity, they always take a small test trial of any new supply of coal to see how the power station responds to it. In the same way as a user of a new cloud, before they enter into a multi-million-dollar deal, they do a little test on Amazon first or on Rackspace, and they see how it responds, and they use that test in order to look at the future economics. Now, a power station, the old-fashioned way of financing power stations is to turn up with 100% of the capex as an equity investment, and then to build it and hope that the pricing turned out to be okay. Nowadays, people turn up with 20% of the equity and they borrow the 80%, and the bank says, what's your future cost of coal and what's your future pricing for the electricity? Is this going to make money? And they go to traders for a hedge. Now that power station and that coal mine both need certainty on the future price, and they're on opposite sides of the equation. Unfortunately, once digging out a type of coal that is incompatible with that particular power station, even if they did reach financial close on the same day. What they need is a market mechanism in order to allow those trades to go through, and the first step is not jump straight to an exchange model, because those trades happen on different days. Someone has to hold the risk. A trader steps into the middle and he says, right, I'm not prepared to buy based off of that particular type, but there's this index of pricing that is a benchmark of indices of all of the different types of coal, and we're going to price based off that. And he does that on both sides, and the risk that the mine takes and the risk that the power station takes is that the difference in quality between what they produce or what they need to consume, the difference between the price for that and the price for the benchmark, that needs to vary slowly compared to the price for the benchmark. This is all about benchmarking, not standardization. Potato growers, you cannot tell potato growers that they have to grow standard potatoes. We're getting closer to that point by not growing them in soil, but they are still, there are still differences. The fish market, there is a very actively traded market in freshly gutted salmon. You cannot tell salmon that they have to be exactly a certain length. Every single one of them is off spec. Things do not have to be standardized to be a commodity.
You know, what came to my mind is the realization that there's a mental gap that has to be crossed, I think, between IT and finance. It's tough for us as engineers and software developers and folks who've just generally built a career in IT to kind of get there and understand how something like IT infrastructure on demand could possibly be a traded product. And James has eloquently highlighted, you know, why you would want an exchange, why you would consider that good for your business, whether you're a producer of it or you're a buyer of it. But I think what is required is a little bit of an illustration for how that actually materializes. This is not something that the proponents of a cloud futures market believe will sprout up tomorrow morning when we recover from the hangover that Jocelyn is facilitating. This is not an overnight exercise. No market develops overnight. There has to be a robust underlying cash market. There has to be willing buyers and sellers in what the industry refers to as an over-the-counter market, an unregulated, back to Joe's point, an origin of all this, kind of an unregulated market, an unregulated exchange. It's only after a certain amount of time and definition of that underlying cash market that a secondary market can exist, a cloud futures market can exist, a regulated market can exist. And there are a few things that you really require in order to make that kind of happen. I mean, standardization of contracts is important. I mean, we have to buy, oil by the barrel or corn by the bushel or what have you. That standardization of contract has to exist, otherwise we can't exchange. We can't buy and sell. There has to be a delivery mechanism that's wholly agnostic in the market. There has to be somebody or a technology or a player that can officially monitor and manage the delivery or the fulfillment of contracts that are bought and sold. That has to be in place. That's all interesting. It's technical and it's non-technical at some levels, but where this really becomes interesting is this chicken and an egg concept of the willingness of buyers and sellers to participate and the idea that there is in fact going to be an endpoint of a cloud futures market. And this is where I believe, tactically speaking, that in order for this to reach that level of viability, a legitimate financial exchange has to be the front and center. This is not something that we as tech entrepreneurs or tech proprietors are ultimately going to deliver to the market. This is going to be delivered by a financial exchange. And if there was a financial exchange that said, okay, listen, we're going to build the derivatives market. It's not going to happen tomorrow, but maybe it'll happen in the next 4 or 5 years. If that were to happen, that's what I believe is the impetus behind what we already observe in the market as willingness of buyers and sellers. Why would a seller want to participate? Well, I'm looking to move volume, right? I'm looking for access to markets. I'm looking to expand geographies. Why would a buyer want to do it? I want to hedge risk, right? I mean, IT is the single biggest fixed asset on the balance sheet today that's totally immovable. Talk to anybody about trying to manage the risk of competitive pressures in the internet industry, right? Facebook versus MySpace, classic example, right? The next, detractor or the next sort of challenger to every industry that we consume on a day-to-day basis as users of technology represents risk. And to be able to manage that risk using a financial exchange or using an open market is ultimately the why in terms of why a buyer ultimately will embrace this. So you've got the willingness of the buyers and the sellers. That much is clear. I think a financial exchange to say, look, at the end of the day, this is the way it's going to happen, and we're going to actually do this, is the catalyst that will kind of shift the gears for a cloud futures market.
What I find as an interesting disconnect in your opening statements is the inherent assumption that people like myself and Mark actually don't believe that there will be a market. When I first read some of Nick Carr's stuff, I immediately thought there's going to be a market. I believe there will be a market. It's just a question of when will there be a market, and I think that's probably where we differ. I think that there are some major impediments to actually having a successful market. Can those be overcome? I don't know. Am I interested in overcoming them? Yes. But when I look at it, two of the main things, one you've already sort of talked about is measurability, and I'm going to talk about that in some detail. And then the second is that it's fundamentally a new kind of market. It's a different kind of market. The things that we're going to buy and trade and exchange don't look like a lot of the other things that we've bought, traded, and exchanged historically, which means there's all kinds of things there that we don't understand yet and will not understand until we start to experiment. So thank you for starting the experimentation. And then the third thing is that the technological underpinnings for a lot of this, except for John Calvin's Sixth Fusion, which obviously solves all problems in world hunger.
Well,
I got the mic.
Something about the squared circle. Let's do it, Randy.
So, the technological underpinnings are not there. I saw BGP peering agreements come into play in ISPs in the early 90s, and there was many years of trial and error before that became sort of a science. At first it was just a black art and a lot of legal. But going back to sort of that first item, measurability, I think one of the things that gets confused is sort of like standardization versus value determination. So when you look at something like 2 lumps of coal, they may not be the same type of coal, but you're going to measure their output in the same way. It's how many BTUs, right? And if you look at a house, right, it's another kind of thing. Like each of these things, you're going to measure the value of. I mean, you have to measure the value in order to know whether the market price that you're going to pay for it is a price you're willing to pay. And so measuring the value is important. And if you can't measure the value accurately, then you have a big challenge. And so I think what happens here is that one of the places what we haven't resolved is what do I do when I take 2 or 3 different workloads and I say like workload A is CPU intensive and workload B is memory intensive and workload C is disk IO intensive, and then I go to 3 different suppliers, each of which have different, you're measuring in some way what they're going to provide you, or you're attempting to, and then it turns out that workload A is completely not impacted from provider A to B to C. There's absolutely no difference in how the workload performs. B, the workload performs very differently, and C, somewhere in between. So in that case, you sort of have a problem because the people consuming the resource have wildly differing experiences. So it's not just measuring the resource itself, it's actually measuring how your workload rides on it. And it's not just, doing something as simplistic as, tasting AWS for a few days and then determining that's going to work well for you. I mean, that's not good enough. And then kind of to sort of it being a new marketplace, one of the problems is that you're basically selling temporal resources, right? Those resources are always there. AWS or some other public cloud has a bunch of fixed capacity, and as long as it's powered on, it's creating value, even if nobody's using it, right? That value is just uncaptured, right? And you don't see that in a lot of other kinds of commodities markets, right? I know you know more about commodities markets than I do, but and so you can school me there, and that's fine. But if you look at some of the examples you gave, and a lot of those, the value creation happens at different points in time. It's not continuous. And so, that brings up the questions of, how often do you measure it? What is the value you're measuring? Back to the kind of the first point, and so on. And so I think that, if we don't get our hands around those things, and if we don't figure out what an exchange or a marketplace needs to look like in order to actually do real-time assessment, because what I buy from Amazon today might be fundamentally different from what I buy from them in 6 months. But if I buy a house, today in 6 months, it's the same house, 6 months older. If I buy pork bellies today in 6 months, it's the same pork bellies, right? I mean, relatively speaking. So that's a little bit of a challenge as well. And so I just think that we need to deal with those sort of three key things: measurability of the system, particularly around the value that it's generating on a per workload basis, the actual fact that what's being exchanged, resources that are being exchanged are fundamentally different than resources we've exchanged in the past, and so it needs new thinking. And then third is that the technical underpinnings need to be there so that we can do this real-time measurement and we can actually put it all together.
What we're beginning to do is deliver cloud services, primarily in the storage area, huge amounts, petabytes of storage to the government and to the medical industry. I was wondering why we were invited to such a prestigious group, and now I know. I think most of you would call us operators, and we have real needs. And let me explain to you a real situation that we have right now. The government is shifting to a model of no guarantees. So Bob and I have to come up. Bob's background's IBM, mine's Texas Instruments and the government. The system that we're about to put in place now requires about $100 million of upfront cash investment. The government will not guarantee any portion of that, nor any usage of that. So what they're doing is wanting...
Classic.
No. It's happened. Most of you saw the CIA bid between IBM and Amazon. We were the underlying storage technology for one of those. You know, they would not guarantee, other than some minor, a few $1 million upstart, maybe even a little bit of guarantees. So we're sitting there with $100 million of investment with the government saying, we'll pay you this price per gigabit of storage. Now, mine's easy. You know, we know that we're a gigabyte of storage. Well, that's what we sell. We sell that on a cloud consumption basis, you know, to these customers. But they won't guarantee that. Now, take that analogy, and I actually own a farm down in Georgia also, and I sell every bit of corn that I expect to produce before a seed is ever planted in that ground. I know what price I'm going to get, and I may hedge a little bit by holding back 10% of what I expect to do. What it would help us in these markets, if there was a way to have a commodity or futures pricing that would guarantee me so much, our future, Bob and I know very well what we're going to have to pay. And we're afraid of that decreasing model too, because if you do that, now we've been trying to hold our customers to a flat basis. You buy 50 petabytes of storage at 10 cents a petabyte, and you have to retain that for 4 years. That's the only way you can really get financing. But that's going to put that customer, if that market goes down, all of a sudden they're going to be paying us 10 cents and the market's gotten down to 1. We're going to have all kind of trouble, and so they're going to want a futures market.
Good lawyers.
Yeah, and so you know, every contract we're writing right now has to be extremely tight, and even that hasn't been proven. You know, the government can walk away from. So that's the challenge that we face as operators to do that. The second thing is, always commodities markets have been a driver of capital and allows people to hedge their risk. So let's say we go out. Our next buy is going to be somewhere around $300 million worth of hardware. So I need even a bigger investor. And so at that point, you even begin to get out of the pricing range of the JP Morgans, the you know, Bank of America. You're way beyond the VC groups at that point. In fact, we don't use any VC money because it's too high priced. If you're going to be in a commodities market, you got to find a way to keep it very, very low. So that's the challenge that we face, and I don't know where you come down on the cons and the pros. We would want a commodities market, not to drive down the prices conveniently, but we think we can compete if the prices are stable across that market. What frightens us is not having that market out there after you've invested $50 million. You can't write off that much.